Are investors too aggressively invested in the stock market is what we are going to discuss today. Hey everybody, Serge Berger here. I'm your host of the Steady Wealth Podcast. Excited to be here. It's still summer. It's getting hotter and hotter out still. And what we're also noticing is that the complacency among stock market investors seems to be skyrocketing as well, or at least steadily inclining still from where we were about a year ago. So what I'd like to talk about today is something that I've been thinking about and tracking for years. But what sparked the actual topic today was an article in the Wall Street Journal from last week. And I forgot what it was called. It was something about like stock market, like investors, retirees specifically being too much allocated to stocks. And so what I thought we would uncover here today is I think everyone's aware of the potential reward of the stock market allocations. I think a lot of people are forgetting what are the risks. And so what I'd like to do here today is talk about the potential risks. Now, I'm not talking about risks in terms of like what's the risk of a stock, but the way people are allocated to stocks. So in no particular order, let's start off with one statistic. So if you look at the past, I'm going to say from 2009 up until about 2021, we had a very rampant bull market. In fact, it was about 15% per year on average. It's an average number for the 12-year period, again, from roughly 09 to let's call it late 2021, is what the S&P 500 returned on an annualized basis. It's an average number. That means there were some years that were certainly less, some years a lot more, but on average 15%. And on average, if you look back more like a 90 or at this point almost 100-year look back, the S&P tends to return closer to, I'm going to call it 7 or 8% per year. That's a bit more normal. So we've had a way above the mean kind of return for the past 10 years. Which is but one of the reasons why we're starting to see among retirees in particular, and obviously the retirees right now are baby boomers, or many of them are. But this actually starts at age 50 and maybe even younger. Now, obviously, younger investors tend to have a higher quota of equities because they have a longer time until they retire so they can stomach more volatility. And that's exactly what I'm trying to get at. So follow me through this. I'm going to make a few points, and I think it's going to start to be very clear. So my goal at the end of this little podcast is I would like everyone to rethink their allocation to equities, particularly if you are aged 50 and over. If you are 55, 60, 65, 70, 75 plus, absolutely this is even more important for you. So, and I've got a couple charts that I'm going to talk about for those people that are watching this out on YouTube. I will show you those charts as well. As always, it doesn't matter if you can't see the charts. If you're on one of the Apple Podcasts or Spotify, I will describe it to you just as well. So just don't worry there. So let's start unpacking this a little bit. So I started off the chat here today talking about the risks of having a bull market mentality basically through thick and thin. Now, again, we've had a 10-year bull market, or call it a 12-year bull market from 09 to 21, and a lot of people got more and more bullish because, well, stocks go up every time, right? And then, of course, the Fed bails you out when something bad happens. At the same time, interest rates have been on a decline for like 40 years, right? So in the early 1980s, interest rates peaked as we came out of the 70s. Then they gyrated around. We had a sea change, and then rates had a long-term up trajectory. And then in the 1980s started declining sharply all the way through the 90s, 2000s, 2010s, all the way into basically 2020, 22 actually, and then actually late 21. And then they started rising. And of course, we know what happened since then. We've had a massive rally in bond yields. So essentially, there's an entire generation, and I'm going to argue probably a couple of generations, that are just not attracted to bonds. And I'm not here to beat the drum on just, being a bond investor only, by no means. But essentially, that's what's happened. We've had a lot of people have no empirical evidence, unless they're professionals, of course, in the market, to invest in bonds. And of course, I would disagree with that, but they're looking at the lower and lower and lower returns that over the course of a 40-year period throughout their career, and literally most of their lives have just been a fact, right? Lower bond yields. So that gets us back to the investing cohort that I'm mostly talking about right now. But again, it also extends into younger generations. But I'm going to particularly talk about the baby boomer generation. So if you're not a baby boomer, this is just as relevant to you, because maybe you have a baby boomer parent or a baby boomer friend or an uncle or whatever. Or a child, depending on how old you are. So here's the thing. So for the most of the baby boomers' careers and lives, they've had lower interest rates, and the stock market did really well. Well, why did the stock market do so well for the baby boomers? Well, for one, there's still a lot of basically post-war, World War II economies are booming. That, believe it or not, that has a 40-year effect, plus 40, 50-year effect. Workforce, right? The baby boomers themselves, the demographic of more people, growing U.S. economy, growing global economy, has acted very well for the stock market. Then in the 1970s, the advent of the 401k, a self-directed, and people became more self-directed investors in the United States. And the United States has really always been an equity culture, at least many, many decades back. So baby boomers are stock market investors. And in fact, many more baby boomers than other generations have over the past 20, 30 years turned into self-directed investors. Self-directed investors, according to statistics, particularly baby boomers, are much more prone to over-allocate to equities. So let's be very clear on that. Baby boomers in general already, based upon what I just said, are overly allocated to stocks because their empirical evidence through their lives is that stocks go up and bonds are crap, right? Bond yields go down and they're making less and less money with that. So if they have an investment advisor who's got a mandate to be more balanced, maybe they have some bonds, but the self-directed investors, who we've seen a big rise of that, the do-it-yourselfers, the part-time do-it-yourselfers, they're basically all in stocks. And when I say all, they're probably 70 to 80+% on stocks. And I've seen some things that are astonishing and quite frankly scary. And we see this every month. We see people come to us over at Blue Marlin Advisors with people that are 70, well over 70, well over 80, with portfolios that are literally all stocks, like 90% or 100% stocks. And so here's their rationale. Their rationale is, again, I've lived through my life, and the stock market's always gone back up and made new all-time highs. And in fact, there's people out there, basically running entire gazillion-dollar asset management companies based around that. And that is correct. Stocks in the United States, and let's be clear, this is U.S. stock market math and maybe Europe math, it has been true. Where I think the real big mistake is being made right now, and this is really the whole point of this podcast here today, is that when I see someone at the age 65 plus or 60 plus, or quite frankly, even 50 plus, having an allocation to equities that's north of 70 or 80%, what they're forgetting is volatility. Okay. So let me describe a couple of charts for you. For those people that are on YouTube, I'm going to show you this now. So give me just one quick second. And as always, I'm going to flip on over to one of my screens. And what I'm going to show you here in just a second and describe to you is just a couple of model portfolio examples that I think are going to make a lot of sense to people when it comes to sort of risk management. So let me show you the entire screen, and here we go. All right. So let me walk you through this. Again, if you're on YouTube, you're going to be able to see this chart. So all I did, and what I'm going to show you right now, is I created essentially three model portfolios, three simple portfolios. One portfolio is 100% allocated to stocks. That's portfolio 1, which is again what a lot of investors have. Portfolio number 2 is a 50-50 allocation, so 50% stocks, US equities, and 50% total US fixed income. Portfolio number 3 is 40% US equities, 30% US bonds, and 30% gold. And this mix here, neither the 50-50 nor the 30-40-30 that I described are meant to be advice or anything. I'm just trying to get through an important point. So portfolio number 1, which is the all equity portfolio, and again, this is the risk, right? Absolutely has done the best. It's done the best. There's no doubt about it. In fact, it's done the best by a lot. And that's good, right? It's good to be investing in growth. And there's a lot of people that are now currently underwater, they feel, or they have to catch up to retire, and greed comes into play. And when that happens in an investor's mind, what ends up happening is that they're forgetting about the risk. And they're prone, those investors are prone to make the potentially the biggest financial mistake of their lives by now being this much in stocks. And here is why. So let me walk you through this. So if I look at the 10-year record, the 10-year return of portfolio number 1, and 10 years is maybe not a good example because we've had an extraordinary equity market. Let's go with the full data set that actually goes back all the way to 1990. Okay, so the early 1990s. So the full track record, annualized return for portfolio number 1, this is important now, which is all stocks, is 9.8%. Portfolio number 2, which is 50% equities, 50% bonds, has a 7.5% annualized return. And portfolio number 3, which is, again, 40% equities, 30% fixed income, 30% gold, has a 7.5. So now you might be saying to yourself, okay, well, surge between 7.5 on portfolio 2 and 3 and 9.8 on the all stocks portfolio percent annualized return. That doesn't seem like that big. Well, it kind of is a big deal. But here is the thing that I think a lot of people are forgetting. So let's look at what this means in terms of volatility. There's various different ways of measuring volatility, but let's get to it. So the worst year, the absolute worst year, or a maximum drawdown, let's go by drawdown, which meaning like from peak to trough loss of a portfolio, is as follows. Portfolio number 1, which is the all stocks portfolio, had a 50% drawdown. 50. So if you had a $200,000 portfolio and you're going to retire, it's now half of that. Okay? You know what that means? That means you have to make 100% to get back to break even. Now, if you're 30 years old or 40 or 50, that's not so bad. But what if you're 65? And it can take, by the way, 10 years, and I'll show you this, for this to actually happen. And this is where I think people are potentially, and I think a lot of baby boomers are potentially making the absolute worst mistake of their lives financially. If you compare this to portfolio number 2, so portfolio number 1, the all equities portfolio had the worst drawdown, which was 50%. Okay, so half, just completely decapitated. Portfolio number 2, which is balanced between 50% equities and 50% bonds, the worst was 25%. That's not fun either, but 25% down is a lot better than being 50% down. Okay, and then portfolio number 3, which has 30% equities and the rest divided up into stocks and bonds, had the absolute worst drawdown being 19%. Okay, I can give you the numbers here also on sort of within the year. It's less, of course. Like the worst drawdown for portfolio number 3 was 12% for like a calendar year, 16% for portfolio number 2, and 37% for the all stocks portfolio. So. And again, there's very different ways of many different measuring this. For those of you that are a bit more quantitatively oriented, the standard deviation is about 15% for the all stocks portfolio, and I'm going to call it half for the other two portfolios, which of course is really good. So, what does this get us to? Well, this gets us to a extremely dangerous situation that I think a lot of baby boomers are in, and here is why. Let me just be a bit more visual and sort of, I guess, optically kind of bringing out a bit of the awareness here. So here's the thing. As I said before, if you're 50 years old and you have a portfolio that draws down 50% because it's in all stocks, you have to make back 100%. You're 50, so maybe in 10 years, which is, a long time, but nonetheless, maybe it's back to that full break-even point. That's 10 years later. So you've had, if that happens, basically a lost decade. For those people that are on YouTube, I'll show you another chart here. And I'm going to talk about it, so you're not going to lose anything if you're not watching this on YouTube. But there have been periods in time when the stock market did nothing but go sideways. So, for example, from the year 2000 to the year 2013, the S&P 500 had what's called a 12-year secular bear market. What does that mean? It did zero, zilch, nada, nothing for 12 years, right? Now, if you are 30, 40 years old, maybe 50, if your portfolio does nothing for you because you're in all stocks, right? And thus you're basically exposed 100% to a secular bear market, it's not the end of the world. It's not good. It's not fun because you're definitely going to fall behind your peers who are more diversified, who are making income in their portfolio. But it's not the end of the world. However, what if you're 65? What if you're 70? What if you're 75? What if you're 80 plus and you enter a lost decade? Oh, forget a lost decade. What about a lost 5 years? Which, by the way, is very normal. That's not abnormal, right? If the stock market doesn't go higher every year, almost every quarter, the average investor, and again, this is mostly focusing on baby boomers right now, that is in retirement or going into retirement, if they have a 5-year sideways market, it is for most people basically unsustainable. That's sideways. What if they have a drawdown? What if the S&P drops over a multi-year period? What if? I'm not saying it will, but what if? And there's very little forgiveness, by the way, in retirement. So the portfolio, there's a reason why financial professionals make sure, if they follow sort of standard deviation models, that more fixed income is being allocated. And I understand the hesitancy to fixed income. I'm not talking about buying high yield bonds, right? And at some point, by the way, we'll have a problem probably buying US government debt. But for the time being, I still think we're probably going to be okay for that for the time being. Not to scare you too much. But it's about the volatility. So I would like everyone that's listening here right now, particularly if you fall into the baby boomer, give or take, 5 or plus minus maybe almost even 10 years cohort, think about the risk of your portfolio if the portfolio drops 30, 40% and it remains down there for a period of time, like a number of years. How is that going to affect your standard of living? What does that mean for you, your dependents, maybe your husband, your wife, your children, your grandchildren, anything, right? What I'm trying to do in this podcast is I'm not trying to scare you in this episode, but I'm trying to make you think. And the Wall Street Journal article to me was sort of the last straw to say, you know what, I need to talk about this publicly. And if it wasn't the Wall Street Journal article, I would have gotten to it anyway, because again, we talk to people every month that come to us and they have portfolios that are insanely correlated to essentially all stocks, and even worse, to basically just the S&P 500, which yes, the S&P does go higher, but it doesn't go higher every day and every year. So this is a really, really important point, and I hope it's resonating for those people that are willing to listen and think about risk and not only about reward. So if you are a self-directed investor, and you tend to be if you are involved with us over at the Steady Trader, I would really encourage you to diversify your portfolio. Diversified away a little bit from stocks. Diversified into some fixed income, some gold, some commodities, just anything, right? Diversification. And no, diversification does not mean you take 50% stocks and put it into 50% cryptos, right? This is not an anti-crypto comment. The problem is it's volatile, right? The whole point of this podcast is the volatility, right, of this episode today. I want to make sure everyone's aware that it's not just about returns. It's about being aware of the volatility that is embedded with the stock market. So with higher reward has to come more volatility. You have to get rewarded for taking a higher risk, right? You see how that works? You're going to get rewarded less for taking less risk. So paradoxically or ironically right now, you can make 5.5% risk-free in 6-month T-bills if you hold them to maturity, of course, in 6 months. And the risk that one has to take to make the same amount in stocks is enormously more. Long story short, folks, there is an absolute mania in the stock market when it comes to overly allocation in stocks. I'm not talking about valuations, right? So this is not an anti-stock market comment. I'm in a lot of stocks as well, but there is a lot of diversification. So I hope this is helpful for you guys that are again, anyone that's a self-directed investor. If you are interested in getting more diversified and us having a look at your portfolio, come on over to Blue Marlin Advisors. So it's www.bluemarlinadvisor.com. You can click a little link there and we're happy to talk to you and look at your portfolio and see what's possible in terms of diversification. Hope it helps, folks. And we'll see you again in the next Steady Wealth podcast. Thanks for listening and be well.